and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, August 25th, and I'm recording this from my office in Purchase, New York. Since the end of the bear market in 2022, the bullish narrative for stocks has included ambitious expectations for interest rate cuts. The current bull run is no different, with markets now putting the odds of a rate cut in September at more than 80%. We acknowledge the political pressures on the Fed to ease, as well as some labor market cooling that might support a proactive cut. Overall, however, we see the case for a rate cut as modest at best, and we put the odds much lower at around 50-50. The question is, what problem is the Fed trying to solve by easing rates? It's important to consider what the rationale for cuts is unlikely to be. First, it can't be the economy in our view. On a nominal basis, GDP growth continues to run above 5%. Unemployment is where it was a year ago at only 4.2%. Retail sales continue to grow ahead of expectations, and investors appear confident that the economy will remain resilient, judging by the extreme outperformance of cyclical stocks versus defensive. Second, financial conditions are the most constructive that they've been since May of 2022 and have actually eased since April. Issuance in the corporate bond market is near record highs, and credit spreads are still near their tightest levels in 18 years. The availability of bank credit is the best it's been in 2 years, and M2 or money growth is above 4.5%. The markets are also not pressuring the Fed to cut rates. Unlike the great financial crisis or the disruptions in the repo market in 2018 and 2019, today most investors are anticipating a constructive environment with deregulation and easier capital requirements for banks, which will only free up more liquidity. We think that market stability is excellent. Equities are in fact at all-time highs. Valuations are in the 95th percentile on almost every metric going back 80 years, and market volatility has been low. Finally, and perhaps most importantly, inflation remains well above the Fed's 2% target, which could be a problem, but not one that supports cutting rates. Year over year, core CPI is 3.1% and core PPI is 3.7%. The full impact of tariffs is not yet visible in the data, with new rates just implemented earlier this month. And consumers are not optimistic on this score. In fact, the expectation for inflation in the next year jumped to 4.9% in the latest University of Michigan survey. Some might argue that lower Fed rates will revive the housing market, which has been held back by relatively high 30-year mortgage rates. But the Fed only controls the front end of the yield curve, while mortgage rates are driven by longer duration treasuries. And on that front, the term premium for long duration is still rising, reflecting investor concerns over the U.S. deficit and debt sustainability. 30-year yields are in fact higher worldwide due to the increase in global long duration debt issuance. All that said, there is still important data to come, namely the employment and inflation reports for September. And there are other points for investors to consider. For example, if the Fed does decide to ease, the cutting cycle is likely to be shallow, absent a recession, with the benefits mainly accruing to financial asset markets and the U.S. Treasury as the cost of issuing short-term debt declines. We are bearing in mind the many possible scenarios and remain diversified in our portfolio construction strategy. Consider selling small-cap equities, unprofitable tech stocks, and popular but low-quality meme stocks, and be highly selective in consumer-oriented names. Also consider adding real assets to complement the benchmark weighting in passive U.S. equities and favoring stock selection in large-cap quality U.S. names. Rounding out our key recommendations are intermediate duration investment-grade fixed income including municipals, international equities, including emerging markets, private secondaries, and hedge funds. Finally, asset-backed lending and distressed investments in private credit are also advisable. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.